Keisha has been doing everything right for 6 months. She pays her credit card on time every single month. She pays more than the minimum. She set a reminder on her phone. She told herself, "This is the year I fix my credit." And then she checked her score. It went up 11 points. 11 points in 6 months. Keisha is sitting there like, "I did everything they told me to do. What is going on?" And the answer is, she wasn't doing everything. She was doing one thing, and the system has 5. Here is what makes this even more frustrating. Keisha is not alone in this. Most people who are actively trying to build credit are only focused on one factor: payment history. Pay on time, don't miss a payment, done. And yes, payment history matters. It is the biggest piece of the puzzle, but it is only 35% of your score. 65% of your credit score is controlled by things nobody ever explained to you. And those things: credit utilization, length of history, credit mix, new inquiries, those things can quietly drag your score down even while you are making every payment on time. That is the trap, and if you do not know it exists, you will be stuck running in place for years. But here is what I want you to know. Once you understand the full formula, not just the payment part, your score can move. For real. Not 11 points in 6 months. We're talking 30, 40, 60 points or more in the same time frame. And you do not need a credit repair company. You do not need to pay anybody anything. You just need to understand the actual rules of the game. Because once you see how the whole thing works, you will never look at your credit the same way again.
Okay, so let's talk about the villain here. Credit score myth.
Specifically, the myth that paying on time is all you need to do. That myth is keeping millions of people stuck, and it spreads because it is partially true. Payment history is important, but partial truth is still incomplete truth. An incomplete truth will keep your score parked at 620 forever. Here is how the myth plays out in real life. Example 1. Someone opens a credit card to build credit. They use it every month, but they are spending $800 on a card with a $1,000 limit. Their utilization ratio is at 80%. That single factor is absolutely wrecking their score, and they have no idea. They think they are winning because they pay on time. Example 2. Someone applies for a new credit card, a car loan, and a store credit card all in the same month because they heard having more credit is better. Every single application creates a hard inquiry on their report. 3 hard inquiries in 30 days. Their score drops 15 points before they even use any of the new accounts. More credit is not always better. New credit too fast is actually a penalty. Example 3. Keisha pays on time, pays more than the minimum, but she opened her card 8 months ago, so her average age of accounts is less than a year. Length of history is 15% of your score, and it only grows with time. There is no shortcut for that one. She is being penalized for being new, and no one told her that. Here is the concept you need to lock in today. It is called the credit score formula. The credit score formula is the actual breakdown of how your FICO score is calculated. 5 factors, 5 buckets, each one with a different weight. And you cannot improve what you do not understand. Let me run through it. 35% payment history. This is the biggest bucket. Pay on time and this bucket works for you. Miss payments and this destroys you fast. 30% credit utilization. This is how much of your available credit limit you are actually using. Experts say stay below 30%. The people with the best scores stay below 10. This is the number 1 hidden score killer. 15% length of credit history. How long you have had your accounts. Older accounts help you. Closing old accounts hurts you. Opening new ones lowers your average. 10% credit mix. Do you have different types of credit? A credit card, a car loan, a student loan? A mix signals to the system that you can handle different kinds of debt responsibly. 10% new inquiries. Every time you apply for credit, a hard inquiry gets added. Too many too fast and your score takes a hit. That is the credit score formula. And here is why this matters. You can be doing great in one bucket and terrible in another, and never know because you are only watching your payment history. The credit score formula. 5 buckets, all 5 matter. But here is where it gets worse. Your credit score, the number you see on Credit Karma, on your bank app, wherever, that number is a snapshot. It changes every single month, which means the mistakes people make can be invisible for weeks. You max out your card mid-month, your score does not feel it until your statement closes and the new balance gets reported to the bureaus. By then, you already moved on. You already applied for that apartment. You already needed the score to be solid. The timing of how you use your credit matters just as much as whether you pay it back. Most people do not know that. Let's go back to Keisha. Keisha is 21. She is in her second year of nursing school. She opened her first credit card about 8 months ago, a secured card with a $500 limit. She put it in her wallet and told herself she was going to be responsible with it, and she has been. She uses it for gas and groceries. She pays the full balance every month. She has not missed a single payment. 6 months in, she checks her score, 594. She was hoping for at least 650. She does not understand what is happening. Here is what she does not see. Her $500 limit card, she is spending about $320 on it every month. That puts her utilization at 64%. The credit score formula says anything above 30% is a red flag. She has been running at double that without knowing. Her average age of accounts is 8 months. She does not have any installment loans, no car note, no student loan in her name, so her credit mix is limited. And because she was excited about building credit, she applied for a second card 3 months ago, got denied. That denial still left a hard inquiry on her report. She got nothing out of it, just a ding on her score. Keisha was not failing. She just did not know the full game. Here is what changes when she understands the credit score formula. She requests a credit limit increase on her secured card. Her limit goes from $500 to $900. Same $320 in spending. Now her utilization drops from 64% to 35%. Score improves. She opens a self-credit builder account. It is basically a small loan where the money goes into a savings account. She is building installment credit history without taking on real debt. Her credit mix improves. She stops applying for new cards randomly. She waits. She lets her account age. She checks her factors on Credit Karma instead of just her score number. 6 months later, Keisha is at 668. She went from 594 to 668 in 6 months. Same income, same job, same life. She just understood the formula. Let me show you the actual math so this is real. Credit card with a $500 limit. You spend $320 a month on it. Utilization, $320 divided by $500 equals 64%. The formula penalizes you above 30%. You are more than double that. If you get a credit limit increase to $900, same $320 spending, utilization drops to 35%. That is better. Still not ideal, but better. If you get your limit to $1,100, your utilization drops to 29%. You just crossed under 30%. That is a meaningful score improvement from one phone call to your card issuer. Now let's look at the full picture month by month for someone actively working all 5 factors. Month 1, you request a credit limit increase. You get approved. Utilization drops from 64% to 29%. Expected score impact, 15 to 25 points up. Month 2, you open a self-credit builder loan as low as $25 a month. You now have an installment account. Credit mix improves. Expected score impact, 5 to 10 points up over the next few months. Month 3 through 6, you make every payment on time. You keep utilization under 30%. Your oldest account is now over a year old. Length of history is quietly working for you. Month 6, no new hard inquiries, no new applications, just consistency and patience. Total expected movement from those actions, 30 to 60 points over 6 months. For someone starting at 594, that puts you at 624 to 654 or higher. That is the difference between getting denied for an apartment and getting approved. That is the difference between a 12% car loan and a 7% one. That is real money. Let me put a number on that. On a $25,000 car loan, the difference between 7% and 12% interest is over $4,000 over 5 years. $4,000. That is what a credit score is actually worth, not a number on a screen. Thousands of dollars in your pocket or out of it. Here is what nobody talks about. You can have a good credit score and still be using it wrong. A lot of people get to 680, 700, feel good, and then apply for everything at once. New card, new car, new apartment, 3 hard inquiries in 60 days. Average age of accounts drops because of new cards. Score falls back down. Building credit is not just about getting the number up. It is about keeping it up and knowing when to use it. Old thinking says, I pay on time so my credit should be good. New thinking says, I understand all 5 factors and I actively manage each one. Old thinking says, I need more credit cards to build credit faster. New thinking says, I need strategic credit, the right accounts at the right time, not just more. Old thinking says, my credit score is something that happens to me. New thinking says, my credit score is something I build on purpose. That shift is everything. Because when you understand the credit score formula, when you know that utilization is 30% of your score and you can move it with a phone call, you stop feeling like the system is against you and you start playing it like the game it actually is. I want to be real with you here. Credit scores are not everything. They are a tool. A system built by lenders for lenders. You are not less of a person because your score is low. But the reality is, in America right now, your credit score affects your rent, your car payment, your interest rates, your insurance premiums, sometimes even your job applications. It affects the cost of your life, so you might as well understand it and use it. And the path is not complicated once you know it. Check your 5 factors. Work the utilization first. It moves the fastest. Build length over time. Patience is the only tool there. Add a credit mix strategically. Protect your hard inquiries. Pay on time. That is it. That is the whole game. Keisha figured it out. You can too. Here is your 1 action step this week. Go to Credit Karma. It is free, no credit card required. And do not just look at your score number. Click through to the score factors section. It will show you each of the 5 buckets and tell you which ones are hurting you. Most people find out right there that their utilization is too high or that they have an old missed payment dragging them down that they forgot about. Credit Karma breaks it down visually so it actually makes sense. And if your biggest issue is that you do not have enough credit history, check out Self. It is a credit builder loan that reports to all 3 bureaus. You are basically paying yourself into savings while building a payment history. No credit check to open. The link for that is in the description too. Those 2 tools together, Credit Karma to diagnose, Self to build, that is your starting kit for making your credit score move on purpose. Remember Keisha? She started at 594, paid on time for 6 months and went up 11 points. Felt stuck, felt defeated. Then she learned the credit score formula. She checked all 5 factors. She called about a limit increase. She opened a Self account. She stopped applying randomly. She got strategic. 6 months later, 668. And she is not done. Your credit score is not a mystery. It is a formula, and now you know it. Your financial come up starts right here. And Keisha, now that her credit foundation is starting to come together, she has been asking me, okay, what do I do with this? Like, what is the next level? That is exactly what the next video is about. Passive income for beginners. How to start making your money move even when you are not working. Check it out right after this. If this video was helpful, be sure to subscribe with notifications so you never miss an upload.